Welcome to China Perspectives, a podcast on economic and credit developments in China, featuring experts from within and outside of Fitch Ratings. My name is Jeremy Zook, the lead China sovereign analyst for Fitch Ratings. As we are still in the midst of the 2025 outlook season, in today's episode, we thought it would be interesting to discuss Fitch's China credit outlook for the sovereign, corporate, local government, and banking sectors. Joining me today to discuss these issues are three guests who head up Fitch's coverage of these sectors. Ying Wang, head of North Asia Property, Industrials, Consumers, and Utilities, and co-host of this podcast. Sam Kwok, head of APAC International Public Finance, and Grace Wu, head of Greater China Banks. Welcome all. Before diving into the other sectors, I wanted to just briefly share our macro and sovereign outlook for China. We forecast China's GDP growth to slow to 4.3% in 2025, down from 5% in 2024. External pressures from a likely rise in tariffs by the U.S. will add to challenges for China's economy at a time when the domestic economy is still trying to find its footing amid ongoing property sector challenges, subdued household confidence and consumption, and deflationary pressures. Our baseline for 2025 does incorporate an increase in the effective U.S. tariff rate on Chinese imports to 35% from 10%. But this is, of course, subject to very high uncertainty. We expect that the recent intensification of both the fiscal and monetary policy response to the economic growth challenges will be sustained in 2025. Fiscal policy, in particular, will be a key policy tool for the authorities this year. Further details on the government's fiscal plans will be forthcoming when the budget is presented in early March during the National People's Congress. We think that it's likely that fiscal stimulus will remain incremental, but will be sizable enough to push our augmented definition of the fiscal deficit to just above 8% of GDP in 2025 from around 7% last year. There is likely to be a greater focus on stabilizing the property sector, as well as expanding the scope of the initially successful consumer goods trade-in program. Though we do expect that there will be a continued focus on infrastructure and do not anticipate any explicit fiscal transfers directly to households. Higher deficits, along with sluggish nominal GDP growth and the ongoing hidden debt swaps, which bring debt from local government financing vehicles directly onto local government balance sheets, will keep general government debt on a steady upward trend from our estimated 62% of GDP in 2024. China's single A+ sovereign rating remains on negative outlook, reflecting the country's deteriorating public finance profile. Sustained wide fiscal deficits and an upward debt trajectory are key factors that we cite, which could lead to a further negative rating action. As such, we will closely be assessing the degree to which the government's stimulus can effectively reignite domestic demand and resolve some of the deflationary risks. Both of these are factors which could support an improvement in the government debt trajectory. So Ying, I want to start with you. Given the importance of the various corporate sectors for the macro outlook, just want to dig into some of the details here. As I mentioned earlier, the risk of an escalation in tariff, though of course subject to high uncertainty, is really a key challenge for China's economy in 2025. How do you assess the impact of potential tariff hikes on the corporate sector under Trump's second term?
Yeah, Jeremy, I think further tariff hikes would intensify pressure on sectors more heavily reliant on the US market, such as electronics, machinery, and textiles. While some sectors with less direct exposure to the US market may face lower immediate impacts, they're still vulnerable to the broader risks of a global slowdown if Trump extends the tariff hike to exports from other regions as well. For instance, sectors like solar PV manufacturing could face prolonged overcapacity if additional trade barriers are imposed on China's origin exports from third-party regions. Also, escalating trade tensions could further erode investor confidence and suppress corporate investment, which compounds the challenges for China's corporate sector.
Thanks, Ying. And the property market, of course, that continues to play a very important role for the domestic outlook. What is 2025 property sector outlook?
We still have a deteriorating credit outlook. We believe the operating environment for China's home builders will remain challenging through 2025. You're right, the secondary home market has recently experienced a rebound in sales volume, but a meaningful price recovery has yet to materialize. And supply in the secondary market remains elevated. As a result, we think the sustainability of this momentum is highly uncertain. The property sector continues to grapple with several structural challenges, including a high inventory of unsold homes, an uncertain employment landscape, and persistently low housing affordability.
Thanks. And, you know, as I mentioned, this year we're expecting kind of a further step up in stimulus. As we get more clarity on the scope and the form of these new measures, do you expect to see an improvement in corporate investment appetite?
Well, I think corporate investment appetite remains quite subdued in general. Especially the private sector entrepreneurs have expressed heightened pessimism. I think a lot of them are still quite skeptical about the effectiveness and sustainability of the government stimulus measures in driving demand. That said, some SOEs probably stand as exceptions because they're tasked with investing in strategic sectors. For instance, state owned auto companies are being urged to ramp up investments in electric vehicles. And state owned power grid and generation companies have kept their capex budgets high. However, not all SOEs are expanding investments. Some, such as the construction companies, are scaling back capex due to slowing order backlog growth and rising receivables.
Thanks, Ying. Sam, I want to turn to you now. Local and regional governments, of course, play a very critical role in China's policy framework and also have significant implications for the sovereign rating. How are local government finances looking for 2025?
Thank you, Jeremy, for the question. Fitch believes it's a long road to recovery for local regional governments, or LRGs. They've got some challenges ahead. You talked about sort of the rapid debt growth over the past few years. So the biggest question is when that revenue is going to recover. So there are two things we want to highlight. So from an expenditure perspective, we believe that they're still pretty much constrained. It's understandable because on the revenue side, we saw some weakness in terms of tax revenue, and we also sort of expect land concession revenue to fall for a fourth consecutive year in 2025. And the second thing I want to highlight is on the debt growth. Now, some part of that debt growth is coming from the debt swap. So from a total system perspective, the total debt between LRGs and LGFVs are the same. Now, the other portion of the debt growth is primarily coming from the economically more developed regions, and it is a trend that we expect will continue to in 2025.
So, one of the key fiscal measures that the government has announced thus far as part of its stimulus was a plan to address hidden debt risk for local governments. And it detailed a lot of this last November when it rolled out these plans. Could you briefly outline the plan and what is your take on this debt substitution plan for LGFEs in 2025?
Yeah, we're talking about a pretty big plan. So this was sort of an important factor towards our neutral outlook for the LGFV sector. So under the plan, local regional governments will issue $10 trillion in government bonds over the next 3 years. Now, this money will be used to help repay LGFV's hidden debt, which is defined by the government as LGFV debt issued prior to 2018. But to be clear, a pure debt swap. So swapping debt with debt, so it's not real money that they can spend. Now, the debt substitution plan, we call it, is quite an interesting move, but it's not really aimed at resolving the long-term repayment of LGFV debt. If we look at the size of the 10 trillion, it's around 15% of all outstanding LGFV debt. So if you split the amount even by the different provinces and regions, the amount is going to be much smaller. So it's really all about improving liquidity and minimizing refinancing risks for LGVs. So Fitch estimates around 2.8 trillion will be issued per year over the next 3 years. And this is the 2.8 is equivalent to around 17% of all LGFV debt maturing in 2025. But as I mentioned before, the plan will relieve some refinancing pressure, at least in the short term. The success really hinges on whether LGVs generate enough returns from the investments, because if those returns do not realize, local governments might need to step in with more support.
Yeah, as you say, the government is trying to address some of these challenges for the LGFE sector. But what are the main risks for the sector in 2025 from a ratings perspective?
Yeah, I would say three biggest risks, from a rating perspective. So first off, as you talked about from a macro front, there are a little bit of uncertainties. Obviously, for LGVs and LRGs in particular, they are influenced by our sovereign ratings. So if you recall, we revised the outlook on 21 government-related entities back in April 2024. So if there are going to be major changes from a macro front, this could potentially have an impact on our view on the sector. So the second thing wanted to highlight, I think, Jeremy, you talked about sort of the increasing deficit, right? So the biggest question is who's going to be paying for the deficit? Is it going to be the central or is it going to be the local, right? So our base case is we do expect that support coming from the central government. But if LRGs are being pressured to spend the bulk of the expenditures and take on the bulk of the deficits, then this could potentially have an impact in terms of the debt growth for LGVs and LRGs. Now, the third thing is on the volatility in terms of access to refinancing. Now, our base case is we expect LGVs will continue to have access to refinancing, but at the same time, there are sort of more and more debt restrictions coming out aimed at LGV debt, getting new debt growth. So, as we know, LGVs are very, very dependent on refinancing. So if there are sort of further tightening on the ability to refinance for LGVs, then this might have a pretty significant impact on how we see the sector.
Great. Thanks, Sam. Grace, I want to wrap up with a discussion of the outlook for Chinese banks. Banks are playing an increasingly important role in China's policy response. We are expecting more rate cuts in 2025. Just wanted to start with the question of whether Chinese banks can withstand more rate cuts given current net interest margin levels.
Thank you, Jeremy. Fitch has maintained a deteriorating outlook on China's banking sector for 2025, primarily due to subdued economic growth, weak retail credit demand, as well as ongoing stress in key sectors such as property and local governments, which Ying and Sam has already covered. These government measures, such as rate cuts aimed at supporting the domestic economy, are anticipated to weaken the sector's profitability. And while falling interest rate might provide some relief against loan impairment, net interest margins, a key measure of bank profitability, remain under pressure. Net interest margins in China have fallen to about 1.5% by the end of September last year, from about 1.7% in 2023, and it's already the lowest among emerging market banks within the APAC region. Now, despite these challenges, authorities are committed to keeping stable financial metrics at banks, recognizing the essential role that they play in supporting the broader economy. The real challenge really lies in reviving credit demand, which may prove difficult until business activities resume more broadly. To support this, the authorities have announced plans for core capital injection for the six major Chinese state banks, which we expect will take place over 25 to 26. These initiatives should help maintain stable system capitalization, giving banks the necessary room to support lending activities as well as business momentum. Now, the five largest Chinese banks, which are global systematically important banks, must comply with total loss absorbing capacity TLAC capital requirements. Assuming full inclusion of the deposit insurance fund in calculations, we do not anticipate any material capital shortage this year. However, Chinese banks are expected to remain active on market issuances to refinance maturing instruments. In the past, issuances have been dominated by Tier 2 and A Tier 1 instruments, but we expect some of these will be replaced by TLAC issuances in coming years as they're more cost effective.
What about asset quality? Is the worst over for Chinese banks?
Rate cuts could ease repayment burdens, and regulatory forbearance extended to developers and micro enterprises might mitigate near term default risk and impairment recognition, offering temporary relief to the banking sector. However, stress in the mainland property market continues to affect consumer confidence and prospects for household income, which indirectly affect local government revenues through weak land sales and personal consumption. We expect wholesales to remain sluggish in the near term due to the structural challenges that Ying has highlighted. But large Chinese banks generally have greater exposure to higher tier cities in their mortgage portfolio compared to smaller regional banks. This helps mitigate the risk on mortgage delinquencies, but we are closely monitoring signs of rising stress amongst other unsecured retail loans and inclusive lending. Direct lending to developers is limited to around 4% of system loans, but household debt servicing capacity, consumer confidence, rising system leverage, and the property market all weigh heavily on the asset quality outlook. We expect about 9% loan growth this year, though growth in total social financing may be lower due to stagnant corporate bond issuances and shadow financing. Our base case assumes broadly stable system leverage over the medium term, which implies no aggressive bank lending, as excessive leverage could negatively impact our assessment of the bank operating environment. In short, lower interest rates should ease repayment burdens, but broader effects on banks' asset quality and credit costs will depend partly on how the stimulus affects property demand and economic growth.
Many thanks, Ying, Sam, and Grace, for joining the podcast today and sharing Fitch's China sector outlooks for this year. 2025, as we've discussed, is a year of heightened uncertainty and challenges for China, but there are a number of emerging opportunities to keep an eye on. So I'm sure it'll be a busy year for all of us as we monitor developments in China. Our 2025 Outlook reports are available through the Fitch website, so I'd encourage our listeners to take a look. You've been listening to Fitch Ratings China Perspectives podcast. To learn more about our ratings and research, visit us at fitchratings.com. And please subscribe to us on iTunes, Spotify, or wherever you get your podcast. Take care until next time.